into a little bit more of the financial worlds here, because there are a lot of different ways that people can invest, and certainly you're an expert in those arenas. Talk a little bit about maybe some of these broad types of ways people can invest and the pluses and minuses of each.
Well, what really goes on, and I think this is appropriate now that we're at new highs on most of the popular averages, is that people make a lot of mistakes mentally when they're investing. And, investment is some science, but a lot of it's emotion and psychology. So you have to be careful of these decisions, of how you think about this stuff. And basically, these errors fall in three parts. They're group errors, group-related, individual-related, and then there's probability-related. In the group area, one of the first and worst one, and you're seeing it both in investments and in the political life, is what's called in-group thinking. And we surround ourselves with only those people who think like we do. And it gives us a sense of security because we don't have to argue with anybody, but it also creates anger and intolerance of the other group. And when you do this in the stock market, what you're doing is you're only finding people who agree with the investment decision you're making, which causes you to make the wrong decision and not see anything bad coming down the line. It's very common to see this.
I think a great example of that also, though, is the political TV stations that people watch.
Oh, yeah.
Because you end up with, people on the right watch Fox,
Sure.
people on the left watch MSNBC,
Right.
And then all you do is hear about how right you are and how wrong everybody else
and of course,
is.
we know that none of them would shade the news or do anything like that ever.
No, and
Just like you can't put anything that's not true on the internet.
It's also such breaking news, too. It's such important things that are happening all the time.
Exactly. And we'll talk more about that in another one of these issues. The second one that's out there is very common, what's called the bandwagon effect. And that is when things are going up or going down, people get all grouped around the thing, and they keep pumping on it. And this takes stock markets up and down, takes stocks up and down. But what's interesting about the bandwagon effect is it is the precursor to any major turn in the market. People are always on the bandwagon, positively or negatively, just at the bottom of the turn. And that's why individual investors, a lot of investors, don't do well, is because they get excited just exactly at the wrong time.
Well, and I noticed that also, again, on television ads, where now somebody like E-Trade or Scott Trade are going, the market's all the way up.
Right.
Now it's time, and they play on this, the emotion of getting people to buy in now that the market is already at highs.
Well, and this is a bandwagon effect is mostly driven by fear and greed, which are two of the strongest emotions that humans have. And you saw a lot of this in the real estate market prior to the 2008 collapse. People were just nuts over buying houses, and people had 5 and 6 houses and hoping that they could refinance them every time. So you get on a bandwagon effect, and of course that was the wrong time to do it. Right time to do it was 1999. So the other one that's out there is what's called negativity bias. Human beings, negative information is more powerful in the human mind than positive information. It stays longer. Everybody can remember the stock that they lost money on. Very few people can remember the stocks they win on. And if there's one stock in a portfolio that's down 40% and everything else is up 30 or 40%, the clients tend to focus on the thing that's down 40%. Now, the news media plays on this, and this goes back to the issue of the in-group thinking. The news media pumps out negative information because it sells. It's that simple. And you will remember it, and you will come back to get more negative information. It's really perverse, but people do it. So the problem with this in the stock market is that when you're negative, when you've been conditioned to be negative, you have to remember the stock market's a leading indicator. It's always forecasting 6 months in advance. So when you're negative, you're going to miss the turns in the market because you're still negative while the market has suddenly spotted things 6 months away, and it's going to turn. And it's a way to lose position in the market by being negative. That's why people sell out at the bottom, is because that's a time they're the most negative.
And that's why people are buying in right now. I mean, it's just that flip-flop, right?
It's a flip-flop. Now it's the bandwagon effect. It's going up. I'm out, and I'd rather be out. The pain of being out is starting to overcome the risk of losing money.
And is that maybe originally why? Well, not originally, but a few years back, why the stock market goes from 14,000 all the way down to something around the 6,000s, and everybody's getting out at 8 and 7 and 6,500 or whatever. And then as it gets to the bottom, I think it was Warren Buffett who says, I would buy everything I can right now.
Well, I remember, being a dinosaur, I remember a lot of times in the past, and I remember great stocks selling at little price. I'll give you an example of this whole thing. Look at Apple Computer. 6 months ago, Apple Computer was going to be the first company priced over $1,000 a share. It was going to own the world. It was going to put Microsoft and Google and everybody else out of business. Today, Tim Cook, president of Apple, could be elected Pope tomorrow, and the stock would still go down because everybody suddenly become negative on the company. They can't do anything wrong.
But here's what's interesting on that. Didn't they make $53 billion or have a $53 billion quarter?
Yep.
But it's just not enough to actually substantiate the stock prices. So it's you go back to that negativity bias. It's a great company. I mean, they are selling ungodly amounts.
Well, you look around the studio. Look how many people got iPhones, iPads. I mean, almost everybody here has
like
got
9
an Apple
of them.
product.
And there's only 5 people here.
Exactly. So, I mean, it's a great company. Is it going through a slowdown? Sure, they all do at some point in time. But right now, the negativity bias is so strong that nobody will give the company any credibility for anything.
You brought that up. It must have been 6 months ago on this show.
Yes, I did make
you
a
did,
good call
and
there.
You made a thing on. You made an entire a whole segment on Apple and how the growth was completely unsustainable.
Well, you can't. A company that big can't grow that fast because pretty soon it'll own all the money in the world. Mm-hmm. It has to slow down at some point. So it's just a matter of finding out when. Microsoft did the same thing. So did Oracle. So did all the rest of them.
Yeah.
So those are the group ones. Those are the ones we find ourselves in a group. Now, there's some individual things that we get ourselves into. Probably the most common and certainly the most dangerous is confirmation bias. And there's nobody in the world who isn't guilty of confirmation bias. And that's basically defined this way. You see what you want to see. You hear what you want to hear, regardless of facts. And you tend to ignore facts because the information you're seeing confirms you. This is a huge problem. It's a huge problem on Wall Street. It's a huge problem everywhere. You just have to start. You have to make an effort to get information which disagrees with you, however painful that is. Otherwise, you'll lead yourself right down the primrose path. Mm-hmm. The second one is called the gambler's fallacy, and you see this in sports. You see this a lot of places. Here's a theory: if you're playing roulette and there have been 28 straight ball drops into red, what's the probability the ball will drop into black on the next roll?
Same as it was the one before.
1 in 48. So the streaks don't exist. Just like flipping a coin. If you flip a coin 28 times and you come up tails 28 times, the probability of a heads on the next flip is 50-50. It doesn't get reduced because you built up 28. So people think that because the market's gone up, it's going to continue to go up, and that doesn't necessarily work. The chance of the market going down on any given day is exactly the same as it going up on any given day.
Is there nothing to be said about momentum?
Yes, there is. Momentum can be dangerous. The momentum of the market will move, but momentum of the market is sometimes is related back to bandwagon thinking. It's people want to get on board. That creates the momentum. The market goes up. That creates more momentum. It becomes a self-fulfilling prophecy. So you got to watch this stuff. People want to feel good about things, and markets going up make them feel better than markets going down. Even though they like market, they're going to remember the market going down.
And Dennis, we have about a minute and a half left. But
I got 3 more pages here.
I know. I bet you can go. Rock and roll, buddy.
I haven't even sold a Tukwila yet.
Well, going back to what you just said, though, just on the markets going up, real estate values going up, this all then starts tying back into consumer confidence, which is up. And I think that's where you start seeing the momentum build, and that's where you start seeing a lot of these take place. Is because
that's what the Fed's been doing.
The personal confidence goes up, and now everything's honky dory, and now we can go back about our lives and buy stocks and buy property or whatever, and until.
And this is a dangerous time because people start to fail to believe that risk exists anymore, which is exactly the time that risk is the highest. So you have to be right now. You're looking out there. People are taking on enormous risks at buying some of this stuff for what are going to be miniature returns probably in the future. This is the time people should be de-risking. They should start thinking about what they're going to do in the future, not trying to take on more risk.